Today, we're joined by Seth Weissman, founder and managing partner of Urban Standard Capital, a New York-based real estate investment firm active on both the equity and debt sides of the business. Before launching Urban Standard Capital, Seth spent time at Goldman Sachs and Perry Capital, and he's known for blending design-driven development with disciplined private credit investing. We talk about how he got into the business, first as an equity owner and later as a lender, his experiences with some wild borrowers, and his take on the current state of the real estate market. And with that, let's go ahead and get into it.
So here's the project is, it was a $200 million loan.
Yeah.
He has built this project on Wilshire in Beverly Hills, on the wrong part of Wilshire.
Yes.
It's a glass box, so everyone can see in from the street. But it's very important. He built it in the wrong place, right? The units haven't sold. And he was at, I don't remember the number, 3,000 or 4,000 a foot asking.
Yeah.
Right.
Which is, for that market, is really insane.
And also for the wrong location. I do believe that if you deliver something in the right location, there's an Amman that's in the right location. Anyway, so I said to him, and we do a lot of this. I'm like, okay, you have your Schedule A price. Your thesis is that when this restaurant opens, all of a sudden
It's going to boom.
It's going to boom.
Yeah.
I hope that's true. Genuinely hope that's true. But in our loan, which is, by the way, going to cost you $2 million in interest per month at 12%, right? We had proposed quarterly sort of what we refer to as sort of like speed bumps. It's like if you have not put X number of units into contract, your own schedule that you have told me, this is my sales schedule, right? This is how I'm going to be selling units. You can reduce the price by X% on those units or start paying our loan down, I forgot what it was, 5% a quarter or 2.5%, something, because I don't want to live on your fantasy.
Yeah.
Right? There may be zero bid here. And if you want to pay for that fantasy and put your money where your mouth is, you think these are worth that and you're willing, and our clients do that, then do that. But I'm not along for this conceptual journey that you're on. Definitely. Because I don't want that for you, and I don't want that. That's just not how we operate.
Yeah. You have to get repaid. You don't sell the units, your costs are going up. There's more carry.
Also,
everything's completely
you bury your head in the
unprotected.
sand. You built the wrong product in the wrong location.
But he's known to be a master at marketing himself and marketing projects. So I'm sure this is looking very sexy, this whole project.
Except
until you dig in.
There's been no
he had
sales.
already he had already completed it. I think it's very easy to sell the we're going to sell it for X and we're going to sell these units. When you're still building it, you can't close units, but he's already finished. People are living there. It's vacant.
This was a bridge to bridge.
Yeah, okay. You're already on.
How much are you taking out?
He was taking out zero.
No, it was cash neutral.
It was cash neutral. It was cash in.
Yeah.
Oh, yeah. Got it.
It was cash in.
But so, but anyway, so the grabbing his balls part, I don't think it referred to the rate because he was already paying a high rate or higher rate. It was the covenants that we had put into the loan proposal, which are okay, if in a quarter, based on you haven't achieved your sales schedule, you can keep your pricing high, or you start paying the loan down. I want you to become more pregnant with the deal, right? If you really believe your own, and we just had this happen in Montauk. We do a lot in the Hamptons, and one of our clients was all right, I believe I'm going to get this price for this house. I didn't believe that. I thought he was high, but he was right. He wrote another $1 million check, replenished the interest, and he believed in the product and the location and the timing. And sometimes these markets, especially the seasonal ones, are a little more time sensitive.
But in this case,
my point is it just happens time and time again, and it's not easy. Listen, you guys know, you're raising money, building credibility in the market. I'm it's fucking hard. This guy is pissing everyone off because that's how he acts all the time.
Crazy.
Failing, losing money hand over fist, and yet again there's something to that.
There is something to that. And what's funny is we somehow went through this without even naming a name, and maybe we'll just keep it that way. And just people can use their best judgment.
It was nuts.
We have interesting interactions in our business, but that was that was not. And you're right. It was a very short call, which was helpful for me because I don't really want to spend my time get to the point. But
fascinating.
I was anyway. I could go on about it for days, but aside from that, much better to meet you in this setting.
Yeah.
Thanks for coming down
Sure.
to sit with us.
Thanks for having me.
Yeah. So Seth, I feel like I've followed your career and what you did with Urban Standard for a little while. I think some people have this idea that you're like that the company became almost an overnight success, granted with 10 years of work and probably even more, right? So I want you to tell your story a little bit because you have touched alternative assets, what I'll call it, in lending, not in the sense of like industrial, but more loans that most lenders wouldn't go to. Definitely not from the institutional lens that I think you and your company have done it with. And I know that that's now expanding and your loan programs are changing and it's growing over time. And it's all super impressive. But like, it's rare that you see a lender lend on a spec home in the Hamptons and then, you know, a $180 million condo project. And so I want you to tell that story a little bit. Can you give us like some of your background just on how you got into real estate, how you built out Urban Standard in its early days and like what the vision was early on?
Sure. So I always have loved real estate. For me, it's the intersection of a lot of areas of personal interest. It's finance, it's architecture, it's design, it's entrepreneurship, it's tangible and physical. So like, it's just something I love. And I feel very fortunate to be able to like do what I love every day, even if there's moments of stress. So when I studied, I went to a school that you could actually major in real estate. So I majored in real estate and finance. After college, I went to work at Goldman in their investment banking group, covering various companies, but home builders among them. That was a great learning experience, but I wanted to get closer to the principal investing side. So went to work for a multi-strategy hedge fund called Perry Capital in their real estate group. And it was there making investments in multifamily in New York City. We had a bridge loan partnership. Those were just randomly what I was assigned to invest in. And Perry was a great place to work, but it was strictly a capital partner. They were not involved in the sourcing of deals, conceiving a business plan, executing on the business plan. So I was really drawn to what our operating partners were doing. Right? It was really strictly an LP. And I had known always that I wanted to do something entrepreneurial. So had the plan to go out on my own and start sourcing, finding deals, which is what I did. My timing was interesting because I think I bought my first building either like 3 weeks before or after Bear Stearns went under.
Wow. Tell us about that deal though. So you went out first on the principal side and found this deal in New York City.
Yeah. So I was focused on multifamily assets to buy that had a value add component. I was specifically interested in areas that were well positioned for transformation. And so one of the locations I had identified back in, 2007, 2008 was the West Chelsea area, right? This was years before the High Line had opened, right? But it was in the works, right? It was before Google had opened their headquarters there.
So word was already out that it was going to be opening and the High Line. So was that already kind of juicing the market a bit or not?
Not really, because the market's pretty inefficient. Right. I mean, I think there's things that are known, but not necessarily incorporated into value in any kind of way that's definable.
And I don't think people knew how big the High Line would be, right? I mean, at the time,
of course, right? Yeah, and also what that led to, right? Would Google have moved its headquarters there if the High Line wasn't there? Would the Whitney Museum have moved, downtown if that wasn't there? Probably not. So I certainly don't think people anticipated the impact it would have just as the High Line, but then further along in terms of the drawing and attracting big institutional anchors, and also leading to all the residential development. So it really transformed.
And for those that don't know, High Line is just an above ground railroad track that they converted to a park.
Right. And it gets something like 30, 40 million visitors a year or something.
Yeah, wild.
And all to say, my thesis was what are areas that have, great access to public transportation, proximity to employment centers, large institutional anchors, right? Groups that are going to be there and help stabilize the neighborhood. And I have always loved distinctive architectural character and identity, right? So I give this as an example, but if you had invested $1 million in 1990 in the West Village and in Murray Hill, you would have made money in both places, right? But you would have made a lot more money investing that $1 million in the West Village. Why is that? What is it about markets like the West Village or Tribeca that have led them to outperform? So part of the thesis was thinking about a little bit with a more macro neighborhood submarket perspective, and then finding opportunities at the asset level where you could really create value. And that could be from renovating apartments, releasing, retenanting, repositioning. And so it was a real heavy value add strategy. Like, how can we transform and grow your top line? And this was remove the Formica cabinets, countertops, replace the appliances, redo the floors, really elevate the product for what the demand was at the time. But it extended further to stuff like building systems. So replacing, your windows with double or triple pane windows to reduce your heating costs, insulating the roof cavity, replacing that old oil boiler from 40 years ago that probably cost $50,000, to run, with one that's gas and more efficient and has controls and what have you, so you can better control your expenses. So it was both targeting the revenue side and the expense side to ultimately drive your net operating income and then monetize that either through a refinance or sale. And I like that physical transformation. It's personally enjoyable to see an asset that might be tired and that might need capital and see it transform and have new life brought into it for, its next phase of its life. And what I did is I sort of went around and, raised capital from, and anybody I thought, could write a $50,000 check, and sort of tapping into a network of family and friends. And
what'd you do first? Did you first go to that network to try and solidify where your capital would be coming from, or did you first find the deal and then go to them?
I basically did it at the same time. I think it's important, even if you don't have a deal, and I'm constantly raising money, even if it's not formally for a deal or opportunity, because it's about relationships, right? It's about relationships and understanding what people are looking to achieve and what, and whether your strategy is the right fit. So whether, it's breakfast, lunch, dinner, coffees, you would talk to people, people that, a lot of people don't make private investments, right? Or they think about risk and return. I had one guy say, I don't get out of bed for less than, 20% IRR. Well, great. Okay, that's good to know.
Yeah.
I don't know if that's realistic on this type of asset or strategy, but I would, at the time, using Excel, now we have a whole Salesforce CRM built out around this, but understanding and trying to match investor objectives with a strategy.
So you would start with an Excel doc with various contacts you had, what they're looking for in terms of returns, how big of a check maybe they can write, what your relationship is with them, maybe last time you talked to them too.
How I met, and also I would ask people for intros. If it's not for you, because I never thought about raising money, and I don't think about raising money as asking for money. I think about it as you have an opportunity, you have a skill set, it's an opportunity to participate in that.
Yeah, you're providing a service for you. You're almost looking at your investors should want this
100%,
right?
And by the way, if they don't, and it could be a variety of reasons, the guy with the Porsche in the garage may not have the liquidity to write a check. That's right. It could be they don't, they prefer investments that are more liquid in nature. It was never personal to me. It was just more of a fact-finding mission and documenting and tracking that. So when the opportunity came along, it wasn't a first conversation.
You weren't scrambling.
And it wasn't an initial conversation. I wasn't introducing myself. I wasn't explaining my track record or whatever. These were warm relationships.
People forget about that. People really, I think people are often way too transactional. And what can you do for me right now? And they forget that it all starts with a relationship.
Yeah. Because especially in the beginning, people are generally, yes, they have to like the deal and believe in the thesis, but they're investing in a person.
That's right.
Right. Yeah. And so, I think that's really important. And I also find, and I sometimes I'll see, this might be a New York City thing, but, wealthy younger folks who have wealthy families who are like, yeah, my family is going to give me millions of dollars to go invest in this property on this project I've never done before.
Yeah.
And I always encourage people to manage, even if you don't need it, right? And most people do, but you see these circumstances, you should bring in other investors. And investors, to me, they represent a lot of things. One, you're stress testing your business plan. right? You can convince yourself of a lot of things. It's helpful to go out and make your pitch, have to answer hopefully good questions.
Yeah.
Makes you think more about it.
Makes you think more, right? It's more of a real deal, right? It's an opportunity, and even if it's ends up being 20% of the capital is outside capital, I think it's a really healthy process to go through. And then if you raise, you get those dollars, you're now in the investment management business, right? And you now have to, and I've, made plenty of mistakes along the way, right? So like, I'm certainly not saying like I've done it perfectly, and I'm continuing to learn and make improvements. But I think it's a really important, career building and business building endeavor is to go out and raise money, be able to answer those questions. You're reporting, qualitative, quantitative reporting on the results. Like
That's a great
So Seth,
point.
when you started working on the strategy, so you went to the multi-strat fund, you did that, you came out of that business and wanted to go on the principal side. Were you still looking to do equity investments, or were you lending? Like, where did that take you?
Great question. So it was all equity investing in the beginning, and this was like as GP and developer or operator buying buildings, I put in money as a GP. I would raise LP dollars, get financing.
If you're managing debt in commercial real estate, it's worth checking out Lev. Lev's the AI platform for commercial real estate. Lev gives you one place to find lenders, launch deals, and keep track of responses without jumping between emails, spreadsheets, and CRMs. You can see everything that's happening with a deal across your team, all in one dashboard. Get the benefits of AI automation without the headache of building agents yourself. It's fast to set up and easy to use, and it's effective. Lev users are launching over $3 billion in deals every month, and they are loving the results. Visit lev.com to try it out. Did you think about ever going in as an LP first and then sponsoring deals so you could kind of learn from sort of the outside looking in?
Well, I sort of had that seat as an LP when I was at Perry Capital.
Got it.
Right. Also, there was the practical reality of my not having the money to like.
Fair enough.
You know what I mean?
Yes.
To really be like an LP of any kind of substance. Because I think I was 26 or 27 or something. So that would have also been a limitation to be transparent. But there's always an element of you just don't know what you don't know, and I'm always aware of that. I try and surround myself with people who are smart, who have more expertise and experience, because you're never going to be, the most informed. I'm never going to be like the best construction person, the best lawyer, the best engineer. You can't be all those things. You have to surround yourself with the people that are, right, and learn from them and have them as part of your team. But I wasn't blind to the fact that like there's a lot I don't know, but I do need to make sure that I have a team that has been doing this and knows. And I think that's also important to investors.
Oh, right? Man, to know that there's a lot that you don't know is very important. Right.
That's before step one.
We're in a remarkably, maybe other industries are like this, but like the arrogance of the real estate community is like next level. Totally. And I'm not, we were talking about the antidote earlier, like.
Yes, that's why I started giggling.
I like to learn from other people.
Yeah.
And I know that I'm constantly learning. I'm constantly making mistakes. Hopefully I don't make, too big ones. And I also, in our company as a culture, want to encourage it's okay to make a mistake. Like ideally, you're not making that same mistake multiple times.
Right.
But it's, we're human beings. It's part of the process, and it's natural.
Yeah. So you started being an operator. How long did you do this for?
So I started doing deal by deal syndications because it's quite hard to raise a discretionary fund.
Sure.
After some initial success, I went back to investors, some existing, some new, and I said, listen, like I'm at a huge disadvantage in the New York real estate market because I don't have the money, right? And any broker or seller who's looking at an offer from Seth Weissman with no money is not really going to take me seriously, or I'm certainly going to have the worst terms, either in terms of price or other elements of the offer, right? That's not a great position to be in. I'd rather have a small bucket of capital that's committed and discretionary, so I can go to that seller and I can say, like, yeah, I know you want $10 million for that building. You've been on the market for 9 months. You probably have some fatigue. My $8.5 million offer may not be what you want. Maybe you were holding out for 9 or 9.5, but we can close in 30 days or less.
And it really changes everything. It changes the tone of your career, your projects, like to have that committed capital. Something I see every day, and New York specifically, because it's the fastest moving market. Like I know when I talk to people on the West Coast or in Midwest, and obviously in a commercial sector, like in office buildings, they're like, what do you mean there's no due diligence period? I was like, you do your due diligence when you're signing the contract.
Yeah.
So it's hard for people to wrap their head around. So obviously it changes your whole tone with the sellers because that's where you're going to make the money. So
and that extends to our business today, and that's why we manage pools of committed discretionary capital, because it translates directly into premium returns for our LPs, right? Like you're entrusting me in our judgment and our team's judgment and assessment. But like if I'm talking to a borrower, like that borrower might have a TOE, like they don't want the risk. I mean, I see, especially now, there's so many tourists in the real estate lending space that have partnerships that like they don't control the money, and they've got to go to ABC Asset Manager or whatever and get the approval. And brokers will bring me, or borrowers like, I have a term sheet from ABC Capital. I'm like, well, you don't need a term sheet from ABC Capital. Who you need a term sheet from is this hedge fund that's their money. Backing them. Because, and by the way, like their terms are great. Maybe we're 50 basis points higher on rate and a little less in proceeds or not. But like, I have sole discretion and sole decision making, right? Yeah. So like, if I'm telling you we're doing this, like you can go down the path with that ABC Capital, but there's two other versions of credit committee you have to go through.
This is fascinating to me because obviously, the credit space is kind of blown up with all these groups trying to get in there over the last few years. What percentage do you think actually have full discretion out there versus?
It's low. Mm-hmm. I think it's probably under 20-25%.
Yeah, and the rest is
in the middle market.
Yeah,
right? Like our specialty is loans under 75 million. Our sweet spot is like checks for 20, 30, 40. In our single family luxury space, it's typically like $7 to $8 million per house. But on like the multifamily side, it's more 20s and 30s. So in the middle market, there's just not that many folks that really have committed discretionary capital. And, ultimately a borrower has to make a decision. Is the certainty of execution and speed of execution worth it to them? It's not even 9 out of 10 times. It's 9.9 out of 10 times. They're always going to go for the certainty bid because typically our loans are 18 to 24 months. Yeah. So whether you're on 50 basis points or 100 basis points higher than the group that doesn't have the money, and you need to close and you need to move on, that's always going to be worth it.
Yeah.
Right. You're not making, that's not if that's the delta in your return profile, it's probably not a good deal. Yeah. Right. And we have established ourselves as a certainty bid in the middle market, but we did that also on the equity side. So once I raised, it wasn't a lot of money, it was like 10 million or so. I was able to have a bucket of capital and I could go out and find more value add deals and get better pricing. The transition from, equity investing to debt, or expansion, I should say, happened in 2016. And the reason we expanded our business was I was really frustrated as a developer and operator dealing with your traditional lender on transitional assets. I remember distinctly one call I had. I bought a 20-unit building in Bed-Stuy, and I think of the maybe 15 of the 20 were vacant, which I loved as an operator because I could get efficiencies and economies of scale to do the work at once. You're not, and the bank's like, well, we can't provide any, loan based on the pro forma income. I'm like, well, I'm going to sit on my hands and just like have these units be vacant indefinitely. Like, guys, like I'm going to renovate these. I can knock it out in 3 to 6 months, lease them up at market rents. At the time, deregulate them, and I just felt there was a huge spread between what I consider real risk and perceived risk, right? And it's easier for me as a person who's developed buildings ground up and owned and operated buildings versus your person sitting in a cubicle who's also hamstrung by whatever regulatory constraints these banks have, which are only getting worse. But at the time, post GFC and all the Dodd-Frank regulatory restrictions that came into play, you were seeing it, right? You were seeing like it just became harder and harder to deal with your traditional lender, and just talking to our team, like, we can do this much better. At the same time, assets, when we were buying like real, 5-6 caps plus upside in good markets became broker forecaps with fake expenses.
Yeah.
And you were priced for perfection. You needed everything to go well.
Marketing is an essential part of landing financing, but creating lender-ready materials can be time-consuming and hold up deals. Stop spending so much time building deal books with Lev Memo. Lev Memo uses AI to create clean, lender-ready deal documents based on the information you already have. You can generate a memo in minutes and send it out right away as a PDF or virtual deal room. No copy-pasting or formatting required. And now, for the first time ever, Lev Memo is available as a standalone tool, so you can use it without being a full Lev platform user. Plus, it has added capability to support investment sales teams. Learn more at lev.com/memo. That's lev.com/memo. Especially 2016 to 2018, there was a massive bull run. Like, not just stock market, I'm talking
absolutely
commercial real estate
and
specifically.
Going back to the point of like, you're aware that you don't know everything and you have some luck on your side. Yeah, if I look back at our track record, it turned out 2008 was a phenomenal time to be buying a property, right? And like being able to buy those assets at 6 caps plus upside covered a lot of mistakes when all of a sudden that like boiler that you thought from your inspection had 20 years left on it blew out, and actually now you're looking at $100,000 fix. Right, that stuff happened, but would be offset by the fact that we had accretive leverage day one. We were able to execute an upside plan. It's very hard to do that when you're buying a 4 cap with fake expenses that's probably really a 3, and you're drowning day one. Mm-hmm. And we think a big part of our investment philosophy is scenario analysis and probabilities of different outcomes, right? And I think developers inherently, they're optimistic people. It's a nice part of the business, but also gets people into trouble. We look at every deal and we say, okay, like this is the base case. This is where it goes well. Most importantly, this is where it doesn't go well. And what are our risk mitigants? It's hard to do that when you're buying a fake 4 cap, right? And you're hoping people leave, or you're hoping rents grow at a double-digit rate. Mm-hmm. I mean, that just doesn't feel like a good business model to me, because it's a lot of things out of your control. So it was a combination of the opportunity set for multifamily in New York felt very frothy, and the debt markets were tighter due to all the regulatory restrictions, and we started making our first loans. And our approach on the lending side was very different from the peers in the market. I mean, now, it's called real estate private credit. It has quite a glow up. It's very fancy and institutional, but this was like hard money bridge loans, right? Yeah. Like it was very sharp elbowed, predatory in nature. This was who you were going to if you couldn't get a loan elsewhere. Mm-hmm. It's changed today. Now I think private credit is very attractive to sponsors, almost as a first choice instead of a lot of bank lenders. But at the time, that wasn't really the case. But our philosophy from the beginning was, we don't want to be loan-to-own lenders. We don't want to be predatory. It's not my personality. It's not the ethos of the firm. Like, I don't want to go to work every day and have my success be based on other people's failures. Mm-hmm. Like, I get there's distressed debt funds out there that, I'm sure do very well, but like, I don't know, it feels like a shitty way to live your life.
Yeah.
And I also didn't think it was scalable. For me, and I go back to my first week of training at Goldman as an analyst, they're like, be long-term greedy. Don't try and make 25 cents today if you can make 5, 10 cents a year from a relationship for the next 30, 40 years. And it sounds very obvious, but we live in a very transactional world. Mm-hmm. Anybody who has had a contractor that issues them a bogus change order, or like a bank that changes terms at the last minute, like these are not thoughtful, relationship-oriented objectives. I felt from the beginning that it was a good fit for our personality and the company culture to be more of a cheerleader to borrowers, but I also thought it was a better business, both from a scalability perspective, but also from, let's have these very sticky captive relationships with our borrowers that we can grow as they grow. Right. I mean, we closed in April a loan that was our 27th loan with that one borrower. We have a lot of groups we've done 5, 10, 15 plus deals with. We closed a loan in June for $35 million. I started with that guy lending him $2-3 million in Bed-Stuy in 2018. Right, he's grown his business, we've grown ours. Like, it's really fun. Like you get to be a programmatic capital partner. Yeah. There's mutual trust and credibility. If there's an issue, you're going to be able to speak like adults and like work through a challenge.
Well, it seems like you're also seeing just such a wide variety of deals. It just sounds like you're doing all sorts of things, different geographies as well. So I imagine it also helps you on the equity side as well, just seeing what's working and what's not working. I don't know. Would you say that's
you see where people are doing well, where they're not, what the common threads are. And a lot of our deal underwriting and our structuring comes from, okay, these are mistakes that maybe we made, right? Like, you need to have these license agreements in place with your neighbor. You need these, buy out 80% of your trades on for your contract.
So how hands-on are you with each borrower and each deal, or is it just specific on that particular project? Or
we're the lender, so we are certainly a step removed. I think we're more looking to make sure that the borrower has that judgment themselves. Certainly we're a resource. I personally, we have 8 people on our investment team, so I'm not like that involved day to day in terms of dealing and working with the borrowers, although I do love it, and I have genuine relationships I built over 15 years.
27 transactions with one borrower, you said.
Totally.
So,
so like that person, we actually just had a payoff on one of them. I was like, congrats, buddy. Like, look for the next. It's a nice relationship.
Yeah.
I've seen him succeed. We've had a lot of benefit as well, and so I definitely maintain a lot of these personal relationships. But I also have built a team. Some of whom you've worked with. It's the same culture, right? And they have those relationships with their folks too.
Seth, this might be a loaded question, but and I say this from the lens like you're so close to this and you've been doing it for so long. You took this from effectively hard money lending into a high efficiency platform. I think you guys are really efficient. I know you guys work and haven't spoken to your team. What is it that makes you guys faster? What keeps your sight line clearer? Like, what's the sauce in that makes you guys this efficient lender?
Sure. First I want to say, like, we're constantly learning and improving, right? So it's not like, I'm happy to hear that, from the outside, if hears that, but like, we're constantly, we just added additional software for our construction monitoring. Like, we're really always investing in the business and learning. And then, this year we'll probably do $800-900 million in loans, right? Like, and that might be 50, 60 positions. So as we've scaled, we've also had to put into place the foundation that's different than it would have been for a business 2-3 years ago. So we are I do think being able to reassess and constantly learn and improve is a big part of it. But I think that's sort of differentiator in the special sauce is that we come from an equity background, right? And so when we're sitting there, everybody on the team has equity experience. Maybe some are more construction and development focused. Maybe some are more asset type or geography focused. But they're having conversations with the borrowers. They can very quickly assess, does this business plan make sense? Right? Like, where does this go sideways? Like, the questions they're asking, the answers they're getting back, they can sort of feel out the bullshit pretty quickly. It also helps that a lot of our clients are repeat borrowers or referrals, right? So you're past that point. You're not assessing the sponsor as much. Like, we always say, we bet on the horse. Being the real estate, we bet on the jockey, but like the jockey part of that, if you've done a deal with them before, you already know. Like, the guy I've done 27 deals with, but anybody I've done 1 or 2 deals with before, I've seen how they act. I've seen how they perform. I understand their track record, their processes, or what have you. So that's easier to work through. But we really, I think in terms of efficiency, the equity DNA allows us to cut through the bullshit very quickly. I don't need a 50-page OM from a broker about what's going on with population growth and
you mean you don't read all those?
No, I don't need 10 pages of photos.
How do you fall asleep at night?
I'm just please, just there's 5 things I need to know.
Sure.
Can you just tell me what those are? And also, if there's things that are bad news, please put that up front.
Yeah.
Right. Don't
hide it. Yeah.
Don't hide it, because if it's something that we can't overcome, I'll tell you. If it is something that we maybe need an explanation on, we're very efficient. We're looking, at a probably review to do $800 million a year in loans. You're probably reviewing $10 billion worth of loans, right? So probably more than that. So it's constant, what do I spend time on? Is this the right fit for us? But can I get the information in a expedited and efficient manner?
The news is important,
But if you're a busy real estate professional like me, you don't have time to skim through dozens of dry and ad-filled media outlets each day. That's why I read the CRE Daily. It's a free email newsletter that cuts through the clutter and delivers concise, witty commentary on the latest trends and transactions in commercial real estate. If you're a commercial real estate professional, you owe it to yourself to try it out and stay on top of what's happening in the industry. It's only 5 minutes a day. Visit credaily.com to sign up for free.
It must be tough right now. I mean, how are you pricing things with, more rate cuts looming? Where do you see things headed, and how are you today looking at term sheets?
Especially just volatility, right?
Totally.
Just news volatility, Twitter volatility.
Everything volatility everywhere you look.
Yeah, I mean, listen, it's the volatility thing. It's one of the reasons I love the credit business. I mean, I had a lunch yesterday with a group of very large investors. We were talking about this, like the volatility in the market and the unknowns is next level, right? You turn on the TV and it's like, what is? I mean, not to get political, but like, what is today's?
Have you ever seen it like this?
No.
Yeah.
Well, it's never been like this.
So this is why it's like, how are you doing this?
So like, our typical loan to value is going to be 60, 65%. So my comment of like one of the reasons I like the credit business versus the equity business is like, I'm not getting punched in the face first.
Right.
There's 12 punches thrown before I have any impact.
Yeah, you're the most protected out of all of them.
And so, I like that dynamic, right? I maybe don't get like the tremendous upside of the equity, but I'm doing okay. Right.
You know what you're getting.
Yeah, I know what I'm getting. We have that downside protection. We're very focused on capital preservation. And so that margin of safety, like, all right, is it tariffs? Is it rates? Is it whatever it is? We have a buffer, right? And on top of that, most of the deals we're financing have a value add component. So if somebody is, spending $100, buying and renovating or improving something, it's because they think it's worth 125. So if I'm, 70 of the 100, like hopefully the person knows what they're doing and they get to 125, but like I'm at 70.
Yeah.
Right. So if that 100 is, if they don't make a nickel, I'm still good. If they lose $30, I'm still good.
Right.
Right. So I have a lot of protection, and we, interest, it's 24 hours a day, 7 days a week, no holidays. Right. Like I'm making money.
It's a good way
all the time.
It's a good way of saying it. Yeah. Sounds great. Why are we not all doing this?
Collecting interest.
By the way, that's why a lot of people have gone into credit.
Right.
Yeah.
Right. Like this is not like unique to me. And when I speak to our investors, like it's very appealing.
Of course.
Because we're earning equity level returns with a credit level risk profile. And what many people don't realize is that lenders are typically back levering their loans. Right.
That's something I really want to talk to you about. Like you stole the idea right out of my head. This is something Jack and I have been seeing over and over and over again, and this topic is becoming like really concerning, right? Especially in the pref space, whatever you want to call that vehicle. That back levering of deferred interest, it's not really getting tracked. There's nothing to track it. It's almost impossible to know like how much of that is looming at the end. What are you seeing right now? Is it something to be worried about or not worried about? Do you think it's just like...
Oh, you're saying like the deferral of interest.
Yeah, So I guess I'll start with my suspicion, right? My suspicion is that a lot of these people in the pref and mezz space and all this private credit that we're talking about have made heavily back-weighted loans because that's how they won the business. It was ultra competitive for the last 2 years. I think a vast amount of them are out of the money at this point.
Yeah.
It's completely blown out. And it's not something that's like bank lending or, it's not something that's widely tracked and no news is picking up on it. So what are you seeing in this
regard? For sure. I'll follow up on like the when I'm talking about back leverage, I'm meaning like if I'm lending somebody $20 million at 10% and I'm borrowing, $12 million of that.
Got it. So your warehouse.
It's more the warehouse. In terms of the accrual, we don't do that because, I think the few times we've done it, they've been very limited. We almost don't even think about that as something like we might see, right? We're looking at like what's paid current or what's funded through an interest reserve. People do that. I would question, is the intention of that pref or mezz holder with that accruing balance to get paid back or to own the asset, right? Because depending on what their intention is, that may be exactly what they want, right? Your $20 million loan that's actually now accrued to 20. Yeah. So I think you just have to be careful about that. But people do that. We do not.
So I'm concerned about both things. The accruals that Alex is talking about, I see a lot in the multifamily space in Texas for sure. I'm seeing from the warehousing side of things though too. I mean, at some point, someone's going to have to say enough, and everyone's cards are going to be shown. I mean, you can't just keep incurring more and more debt, and someone's going to have to get paid. And so I'm starting to see more forced sales.
You're saying with the lenders kind of kicking the maturity?
Yeah, everyone's kicking it down the road more. And I just think it's kind of enough is enough. I don't know if you see that some in your space, maybe not. But
yeah, I mean, I think the assets that were like the 2020 to 2023 pre-rate hike vintage, that's where most of the noise is, right? Maybe 2024. The stuff that's been originated in the last 12 to 18 months generally was re-underwritten and reestablished at a different valuation and price point. But you're absolutely right. I mean, like, you think about a Signature Bank portfolio or a New York Community or any of these banks, they had huge issues because basically their loans actually deteriorated in value significantly. Part of the reason the back leverage space has become so popular among your banking, regional and national bank, is it's a much safer space for them to be in, right? Because if I'm lending somebody $20 million on an asset that they bought for 30 that they're going to make worth 40, so I'm 20 on 30, but my back leverage is 12 on 30, and 12 on 40 of potential value, and they have two borrowers. They have the underlying borrower and they have me. And they're probably charging similar rates. And even like the Fed chair has said, like, that's what we want to happen. The banks that are using consumer deposits to make loans, we want to protect those consumer deposits. Like, we don't want them making the $20 million loan. We want Seth to do that. Seth has like very sophisticated institutional capital. Like, they know what they're doing. Or by the way, if they lose money, it's like, it's not, your retiree who has like 50 grand in their bank account or whatever. So, so I think the system is generally working the way it's supposed to, which private credit in conceptually taking on more risk. I would argue they're not actually taking on more risk, but they're not taking on risk with consumer deposits. They're taking on risk with a much more institutional, sophisticated investor base. And they're at a different attachment point, right? They're 12 on my 20, they're 12 on the $30 million development costs and on the 40. So I actually think it works quite well. Generally, though, what I think, from an investor perspective, if I'm making a loan at, again, 10%, 10.5%, and I'm borrowing at 7 or 8, right? I'm turning my yield on the piece that I'm retaining, that $8 million, is like high teens, 20% returns. Yeah. So when I talk about earning equity level or equity-like returns or the credit level risk profile, it's like, and this is what makes it so hard for equity investors to raise money today, is like they're competing with the narrative for me.
Sure. Yeah.
I'm going to investors, I'm saying, you don't get the quote-unquote upside, but you're going to get a mid-teens return.
Yeah. You're selling their position 75% cheaper.
Exactly. So and by the way, that upside that is often shown on those equity pro formas never materializes.
Yeah, right, for sure. Yeah. Well, on that note, I keep thinking equity's kind of coming back. I think it's a matter of time, especially as rates continue to adjust. What's your take on that? When do you think the market kind of flips a bit?
I think you're starting to see more confidence. I think the recent rate cut and the indication of rate cuts are going to lubricate the market and have. There are interesting equity opportunities when you think about coming in at a reset basis, right? Coming into a lower rate environment. Generally, there are macro tailwinds that exist. So I think selectively there are more interesting opportunities. We just closed a deal in Park City actually, where in addition to our loan, we took a profit participation.
Okay.
We haven't done that in some time.
That's pretty unique and cool.
Yeah. But by the way, the deal works with just the yield on our debt, right? Right. So it's a little bit like cherry on the sundae. But we'll do more stuff like that. We do a lot of bespoke structuring tailored to the needs of a deal. But most of the time, I mean, very rarely am I looking at a deal and be like, oh, I want to be in the common equity in this.
Well, let me ask, like, what does that look like? It's a deal that you really believe in. You offer some sort of preferred terms on the debt piece, and in return get a piece of the promote, essentially. I mean,
I mean, it really it depends. Okay. But like in that case, it's just a percent of the project profits.
Okay.
On top of it.
Okay.
So we could do a variety of things. I mean, one of the nice parts of our seat, especially because we're GPs on the equity side and the debt, I can look at the deal, mm-hmm. I can look at the capital stack of the deal, and I can determine where do I want to be in that capital stack.
And you have the flexibility to do it.
And I also have the flexibility to do it. Right. And my investors have entrusted me with that.
Yeah.
Right. And when I'm going back to when I started, I'm still on a regular basis talking to investors and hearing from them, what are you looking for? What are you focused on? And if it's equity, we track that in our CRM. Mm-hmm. We might have opportunities. I'll connect borrowers with our LPs that hey, they're looking for equity. We don't have, this is not our specialty. Mm-hmm. You're looking for an opportunity zone kind of thing. Like talk to, Joseph or talk to Joe Schmo.
And is that for placement or is that just
as a
relationship building?
It's a relationship building. I'm also like I genuinely do want to see people do well. Yeah. Like I feel like I've been very fortunate, and like if I can be helpful in any way, I try to be. I'm not like looking to put my hand in the pocket. Yeah. But and I think people really like appreciate that value. Right. We'll send deals all the time. We see deals like, oh, this is like a distressed opportunity, or this is being sold. This is right in your wheelhouse. You convert, extended stay hotels into multifamily. Like, have you seen this? Like, it's just a little more in the spirit of partnership, trying to put opportunity in front of partners. Mm-hmm. And it's helpful because we'll say, take a look at this. By the way, we like it. We'll put up 75% of the money on the lending side, or throw in some, pref, whatever it is. Yeah. Like, it's not just like, here's the deal. Here's the deal that could come with money. If you agree, like, and that person might look at that deal and say, oh, we don't like it for this reason, or it's not a right fit, or whatever. But we're relying, we look and value their expertise in the same way they value ours. Yeah. But it's a totally different conversation than you're having with your, certainly a bank and even your more pure play debt fund. Yep. That's like all finance folks.
I don't see many players like you that can get so creative along the capital stack and kind of just do kind of what you want and what makes sense. It's a very cool business. It sounds very exciting.
Look, it's I think the proof's in the pudding. You guys have been doing a great job. It's been exciting to see the trajectory of your company, because I remember very early on when you guys just started getting on my radar, it was always a picture of like beautiful house in the Hamptons, you, the dog.
And she's hanging in there. She's 18 years old.
What type of dog?
Mini Schnauzer.
Beans.
Bean.
Bean.
Yeah.
So it was you, Bean, and and an analyst. I was like, this is so interesting. And then I would see in the posts would just get larger and larger. It would be like 2 million, 6 million, 7 million.
Do you have Bean in your on your website?
Yeah.
So this is.
And she goes to our office we just expanded our office, so she hasn't been in a couple of weeks. But
does she have her own office?
No, it's
well, why not? She needs her own desk.
It's my office. She has a bed, though.
Does she,
That's awesome.
She have an assistant or anything?
Yeah.
I'm her assistant. You're the assistant.
I'm the assistant.
Anyway, I know
this is one of the things I just think is, Alex is trying to wrap this up.
Well, I'm sorry.
Let me just say that I think that having dogs in your office, it's one of the coolest things that you can do. Why more people don't do that, I don't know. But I've been noticing more and more groups. Lucy Billingsley, who we're going to be doing something with in Dallas, she on their office website, they have a couple dogs as well, and it's like chief dog officer, chief dog. Like, I just think it's good for morale.
It's fun. I mean, like, listen, we really like, it's an entrepreneurial environment. It's definitely dynamic. There's a lot you're dealing with at once, which certainly can be overwhelming. Yeah. But I don't.
What's the downside?
Sometimes some pee on the carpet, fall asleep on your foot.
What's amazing is that sometimes other people will bring in their dogs. Like we've had situations where we've had like 3-4 dogs in the office, and then that gets crazy because people are trying to take who has a bigger office? Which dog has the biggest office? No, like more people are trying to have phone calls, and like they can't.
I'm sure Beans is easy to work with too.
She's 18, so
she's seen things.
She's experienced.
She's a senior executive.
She's wise. Well, people ask her like, "What's credit committee?" and I'll be like, "Bean."
I mean,
Yeah.
Talk to Bean about it.
You're going to have to talk
like
to
it.
Bean.
Yeah,
That's so
she's
funny.
not going to lend you that kind of money. That's crazy. And she's got that mustache.
That's
She's
right.
Yeah, that's right.
She's serious.
Yeah.
she's
I
most
love it.
serious
Real maturity.
person in the office.
All right, on that note,
Yeah.
Thank you.
Hey, man, great to have you on. Really cool
Thanks
to
for
hear your
having me. I appreciate
perspective
it.
and to hear about, USC.
thanks, Seth.
Thank you.